On the afternoon of October 9th, 2025, at 4:47 London time, Bruce Ikemizu sat in his Tokyo office staring at a number that should not exist. The one-month silver lease rate had just hit 39.2%. For context, normal is 0.3 to 0.5%. Last week it was 7. Yesterday it was 19. Today, 39.2. Ikemizu, 63 years old, had spent 3 decades trading precious metals for Sumitomo, Credit Suisse, and ICBC Standard Bank before founding the Japan Bullion Market Association to bring transparency to Asian markets. He had seen squeezes before, gold in 1980, palladium in 2000, but he had never seen borrowing costs spike this violently in 72 hours. His terminal showed Bloomberg and Reuters running stories about tech earnings and Federal Reserve commentary. CNBC led with chip stocks. No one was covering the fact that the global silver market had just seized. The official narrative from the bullion banks was clean: temporary tightness, logistical bottleneck, seasonal demand from India's Diwali festival, nothing structural. One major bank's commodity desk had issued a client note that morning. Lease rate spike reflects refining delays, not shortage. Fade the noise. But Ikemizu knew what a 39% borrowing cost meant. It meant someone desperately needed physical silver and could not find it anywhere on Earth. It meant the paper contracts promising delivery were colliding with empty vaults. It meant the largest financial institutions in London were paying nearly 40% annualized interest just to borrow metal for 30 days because the alternative was defaulting on delivery obligations. He pulled up the COMEX registered inventory data, the metal actually available for delivery, down 70 million ounces since August. A 22% collapse in 60 days. London vaults, down 40% since 2021, according to LBMA's own reports. The EFP spread the premium traders pay for London physical versus New York futures had widened from 25 cents to $1.10, and silver had just broken its 1980 all-time high, touching $54.48 per ounce the same day lease rates exploded. Ikemizu typed a message to his professional network. "Silver squeeze is on. This is serious." He hesitated for only a moment before posting it. The banks would call it alarmist. The analysts would say he was talking his book. But the data did not lie. Somewhere between the futures exchanges promising hundreds of millions of ounces and the vaults that were supposed to hold that metal, a gap had opened. And when Bruce Ikemizu clicked send, he became the first major market figure to call the crisis by name while the financial press stayed silent. What he did not yet know was that traders in London were already booking commercial airline cargo space to fly silver bars across the Atlantic, a desperation move normally reserved only for gold because the normal shipping channels had run dry. Or that by October 27th, the CEO of the London Bullion Market Association would announce emergency weekly inventory reporting for the first time in the institution's century-long history, admitting that monthly data had masked a catastrophic vault depletion, or that refiners across Europe would stop buying scrap silver entirely because lease rates had made their business model mathematically impossible. The number on Ikemizu's screen was not a glitch. It was not seasonal noise. It was the market screaming that the divorce between paper promises and physical reality had finally arrived. But the real question, the one Wall Street refused to ask, was not whether silver was tight. The data confirmed it. The question was why, when the futures market claimed there were 200 million ounces available and analysts insisted supply was infinite, no one could actually find the metal when they needed it. The answer was hiding in a chemistry lab in Seoul, a solar factory in Shanghai, and a copper mine in Peru. Because this shortage was not financial, it was industrial, it was physics. And the science behind it would prove that the squeeze Bruce Ikemizu documented that afternoon was not the crisis. It was just the opening act. Let me be clear about what just happened. When Bruce Ikemizu posted that warning on October 9th, the mainstream financial press did not pick it up for 48 hours. Bloomberg eventually confirmed his 39.2% figure, though they cited a peak of 34.9%, depending on the timestamp. Reuters ran a brief mention buried on page 7 of their commodities roundup. CNBC never covered it at all. Why the silence? Because acknowledging a 39% lease rate means acknowledging that the entire narrative around silver abundance is a lie. It means admitting that the COMEX inventories everyone points to as proof of supply, those 200 million ounces sitting in registered vaults, are not actually available when someone tries to take delivery. It means confronting the reality that paper contracts and physical metal have diverged so dramatically that the cost of borrowing silver for 30 days just exceeded the interest rate on junk bonds in a distressed emerging market. But here is what Wall Street was actually saying in those client notes and analyst calls. They pointed to COMEX inventories still above 200 million ounces. They highlighted modest inflows into silver ETFs like SLV. They showed futures curves suggesting normalcy would return within weeks. One major investment bank's precious metals desk told institutional clients that the spike reflected refining delays caused by India's Diwali festival, creating temporary logistical bottlenecks. Nothing structural. Fade the noise. The subtext was obvious. This is a blip, not a break. Seasonal demand will cool, lease rates will normalize, and by November, the market will forget this ever happened. Except the data told a different story, and that story was catastrophic. 3 numbers. Wall Street chose not to publish in those reassuring client notes. First, COMEX registered inventories. The metal actually available for immediate delivery, not just sitting in vaults, had fallen 70 million ounces since August, a 22% collapse in 60 days. Second, London vaults were down 40% since 2021, according to the LBMA's own monthly reports that CEO Ruth Crowell would later admit were published too infrequently to catch the depletion in real time. Third, the EFP spread, the premium traders pay for London physical silver versus New York futures, had exploded from its normal 25 cents to $1.10 per ounce, meaning the market was willing to pay over $1 more per ounce just to get actual metal in hand rather than a paper promise of future delivery. And here's the detail that should terrify anyone holding paper silver. On the same day, lease rates hit 39%. Silver broke its 1980 all-time high, touching $54.48 per ounce. That is not a coincidence. That is the market screaming that paper and physical have divorced. So why can't the market find metal when it needs it? The answer is not financial speculation or market manipulation. The answer is chemistry. Silver has the highest electrical conductivity of any element on Earth, higher than copper, higher than gold. At room temperature, silver conducts electricity with 106% efficiency relative to the standard, which is copper at 100%. No other material comes close, and that physical property is non-negotiable. You cannot substitute it in the applications that matter most, and those applications are exploding. Inside every solar panel sits a silver paste, 60 to 90% pure silver by weight, that forms the conductive pathways, capturing sunlight and converting it to electricity. Here is the brutal reality from the Silver Institute's own data. In 2024, solar demand consumed 232 million ounces of silver. In 2023, it was 193.5 million ounces. In 2014, just 60 million ounces. That is a 287% increase in a single decade. And it is accelerating because the solar industry just shifted to N-type heterojunction and TOPCon cells, next-generation panels that use twice the silver per watt compared to old PERC technology. They are more efficient, so manufacturers are adopting them across the board. Translation: even if solar installations stay flat, silver demand doubles, but installations are not staying flat. The European Union has mandated 700 gigawatts of solar capacity by 2030. China installed 217 gigawatts in 2024 alone. India is pushing 100 gigawatts annually, and every single one of those panels requires silver that cannot be replaced. Can they substitute copper? No. Copper screen printing exists in laboratories. Risen Energy announced they reduced silver use from 6 milligrams per watt to 0.5 milligrams using copper paste. But that is one cutting-edge company with experimental technology, not the industry standard. Scaling copper paste requires retooling entire supply chains, retraining engineers, and replacing manufacturing equipment across thousands of factories. That process takes years, and meanwhile, panel manufacturers face a choice. Pay any price for silver today, or shut down production lines tomorrow and default on contracted installations. Result: industrial demand is price inelastic in the short term. When Samsung needs silver for AI server chips, when solar manufacturers need it for panels already under contract with utilities, they must buy regardless of price. And solar is only 19% of total silver demand. The other 39% of industrial use? Electronics, where every smartphone, laptop, and AI server uses silver contacts and circuit boards. Electric vehicles, where battery EVs use 25 to 50 grams of silver per car compared to 15 to 28 grams for combustion engines. 5G infrastructure, where the global rollout requires silver-coated antennas and relay switches. Total industrial demand in 2024 hit 700 million ounces, a 7% year-over-year increase and a new all-time high. This is not speculation. This is consumption. And once that silver goes into a solar panel or a circuit board, it is gone. Now, let me show you the numbers that Wall Street refuses to publish. Total global silver supply for mining in 2024 was 835 million ounces per year. Add recycling, and you get another 150 million ounces, bringing total supply to roughly 985 million ounces. Total demand across all sectors, industrial investment, jewelry, and silverware, hit 1.21 billion ounces. That leaves an annual deficit of 182 million ounces in 2024 alone, and that was the 5th consecutive year of deficit. The cumulative deficit since 2021 is 800 million ounces, nearly 1 full year of global production, consumed directly from above-ground stockpiles. But here is where it gets terrifying. Unlike gold, where miners dig specifically for gold, 72% of the world's silver comes as a byproduct of copper, zinc, and lead mines. Silver is the side effect of base metal production, which means the silver supply is structurally inelastic. You cannot just mine more silver when the price doubles, because a silver mining company cannot open a new mine unless base metal prices like copper and zinc justify the economics, unless they can secure permits, which take 5 to 8 years, and unless they can find financing, which is nearly impossible for silver-only projects. Only 28% of global silver comes from primary silver mines. The rest is hostage to copper and zinc demand, and when those markets slow, silver supply contracts regardless of how high silver prices climb. Let me show you what disappeared between 2020 and 2025. In 2020, the deficit was 90 million ounces. In 2021, 51 million ounces. In 2022, 237 million ounces. In 2023, 142 million ounces. In 2024, 182 million ounces. Total cumulative deficit, 702 million ounces at minimum, though other analysts cite 800 million to 1.1 billion ounces, depending on how you account for unreported Chinese demand and off-market transactions. Where did it go? From the vaults. COMEX registered inventories fell from 346 million ounces at their 2020 peak to 210 million ounces by October 2025, a 70% collapse in deliverable metal. London LBMA vaults down 40% since 2021, Shanghai Futures Exchange inventories at decade lows, and it is not coming back. Once silver goes into a solar panel, it is gone for 25 years. When it goes into an AI chip or circuit board, most ends up in landfills because recycling is uneconomical at current prices, given the tiny quantities per device. You're watching the extinction of above-ground silver stockpiles in real time, and the market is only now beginning to price in what that means. Every analyst downplaying the squeeze points to 3 obvious solutions. Recycling will save us, higher prices will unlock new supply, regulators will step in like they did with the Hunt brothers in 1980. Let me explain why all 3 are fantasies. Current recycling contributes roughly 150 million ounces per year, which sounds significant until you realize that most modern silver use is non-recoverable. Solar panels last 25 years and the silver is embedded in the photovoltaic cell. Recycling requires heating the panel to 1,000 degrees Celsius to melt it down, which is economically unviable unless silver hits $100 per ounce or higher. Your iPhone contains 0.03 grams of silver. Your laptop, 0.3 grams. At current prices, the cost to extract that silver exceeds its value by a factor of 10. AI server chips face the same problem, distributed in microscopic amounts across millions of devices that end up in landfills because no recycling facility will pay to process them. The Silver Institute estimates that only 35% of silver in industrial applications is recoverable with current technology and prices, and even that requires time. E-waste recycling facilities cannot scale overnight, and meanwhile, solar installations are adding 200 million ounces of demand per year. What about higher prices bringing new supply? Normally, yes, but not for silver. Remember, 72% is byproduct. Silver miners cannot respond to price signals independently. Take Peñasquito mine in Mexico, one of the world's largest silver producers, at 20 million ounces per year. It is primarily a zinc and lead mine. If zinc prices crash, the mine becomes uneconomic, even if silver is at $100 per ounce, because zinc pays the bills and silver is just bonus revenue. And new projects? 5 to 8 year lead times from discovery to production. Permitting alone takes 3 to 5 years in most jurisdictions. By the time new supply hits the market, the shortage has already restructured the industry. The only meaningful new supply coming online is Pascua-Lama in Chile, projected to add 50 million ounces per year starting 2027. That is one project against a 182 million ounce annual deficit. What about regulators changing the rules like they did in 1980 when the Hunt brothers tried to corner the market? 2 problems. First, this is not speculative. The Hunts were trying to corner silver for profit. Today's squeeze is driven by industrial users with legitimate supply needs. Samsung cannot make AI chips without silver. Solar manufacturers have contracted installations with utilities that carry penalties for non-delivery. You cannot regulate away physics. Second, the vaults are actually empty this time. In 1980, COMEX had metal in storage. They just restricted leverage and margin requirements to break the speculative corner. Today, registered COMEX inventories are 70% below 2020 levels. There is no secret government stockpile to release. The strategic stockpile was sold off in the 90s and early 2000s. The metal is gone, and no regulatory intervention can conjure it back into existence. So, what happened when the dust settled? Bloomberg reported in late October that lease rates had fallen back to 5.6% as metal flows from New York replenished London vaults. Silver prices retreated from the $54 peak to the upper 40s. Crisis over? Not even close, because the people who positioned correctly are now sitting on structural advantages. Unhedged primary silver producers like Vizsla Silver, GR Silver Mining, and America's Gold and Silver saw their margins explode. A mine with $11 per ounce all-in sustaining costs suddenly made $40+ per ounce when spot hit 54. Vizsla secured $300 million in financing at 5% interest, unheard of for a development stage miner. Michael Connert kept the company 100% unhedged because he understood that N-type solar cells would create deficits that no amount of paper trading could solve. When the squeeze hit, Vizsla captured the full spot price while hedged competitors had locked in $25 to $30 per ounce. Physical silver holders avoided the paper trap. When lease rates spiked, premiums on physical coins widened to 9 to 12 pounds above spot. If you owned the metal, you captured that spread. If you owned SLV, you got spot price only. On the losing side, COMEX paper shorts holding 275 million ounces net short got decimated. You sold silver at $28 expecting to cover at $24. Instead, it went to $54, and when you tried to borrow physical to deliver, lease rates hit 39%. The cost to stay short became 63.6% annualized. Open interest collapsed 22% in 60 days.